Warren Buffett is a man who has made billions over his lifetime, but few days stand out in his career like February 14, 2017, the day he earned a staggering $12 billion in just 24 hours. It was a financial triumph, the kind of day that most investors can only dream of, and it all happened thanks to one of Buffett's classic investment strategies, long-term value investing. But how did the Oracle of Omaha pull off such an extraordinary feat? Was it pure luck? Or was it another testament to his unmatched wisdom and discipline? To understand this, we need to go back in time and analyze how Buffett positioned himself for one of the biggest single-day gains in stock market history. One of the golden rules of Warren Buffett's investment philosophy is simple: invest in what you understand and hold it for the long haul. For decades, he stayed away from technology stocks. He didn't understand their business models, and he wasn't willing to gamble on industries he couldn't predict. That all changed in 2016 when Berkshire Hathaway made an uncharacteristic move. They started buying Apple AAPL stock. This was shocking to many because Buffett had always been skeptical of tech companies. But Apple, in Buffett's eyes, wasn't just a tech company. It was a consumer business with a loyal customer base and a brand that was almost a religion. By early 2017, Berkshire Hathaway had invested more than $30 billion in Apple. It was the single biggest bet the firm had ever made in a technology-related stock. Buffett wasn't looking at Apple as a tech company. He saw it as a high-quality business with strong customer loyalty, massive cash flow, and a powerful brand. His patience and belief in Apple were about to be rewarded in a way even he probably didn't expect. Fast forward to February 14, 2017, Valentine's Day. The stock market opened like any other day, but for Apple shareholders, something extraordinary was about to unfold. Apple had just released a blowout earnings report, smashing Wall Street expectations. The company's sales of iPhones were soaring, its revenue was stronger than anticipated, and, most importantly, it had a massive cash reserve of nearly $250 billion. As soon as the markets reacted, Apple's stock skyrocketed. Shares jumped nearly $7 per share, pushing its market cap up by a staggering $47 billion in just one trading session. For Warren Buffett and Berkshire Hathaway, this was a golden moment. Berkshire's massive stake in Apple meant that as the stock surged, so did their investment. By the time the markets closed, Buffett's firm had gained an eye-popping $12 billion in a single day. But this wasn't just about one good bet. It was a masterclass in patience, discipline, and the power of long-term investing. Warren Buffett didn't wake up on February 14, 2017, expecting to make $12 billion in a single day. He didn't gamble on a short-term trade, and he certainly didn't try to time the market. Instead, his massive payday was the result of a patient, calculated, and disciplined investment strategy, one that had been building for over a year. So, what made Apple such a compelling investment for Buffett in the first place? Why Buffett bet big on Apple? For decades, Buffett had been wary of technology stocks. He famously avoided companies like Microsoft, Amazon, and Google, even though his close friend Bill Gates was running Microsoft at the time. Buffett's reasoning was simple. He only invested in businesses that he could predict with confidence for the next 10, 20, or even 50 years. Tech companies, he believed, were too unpredictable. One minute they were market leaders and the next they could be obsolete. But when it came to Apple, something was different. Buffett and his team at Berkshire Hathaway started looking at Apple not as a tech company, but as a consumer goods company, one that sold a product with an extraordinarily loyal customer base. Apple's customers weren't just buying iPhones. They were investing in an ecosystem, a brand that kept them coming back for more. Whether it was the iPhone, MacBook, iPad, or Apple Watch, Apple users tended to stick with the company for years, creating an almost subscription-like revenue model. Buffett often compares investing to rolling a snowball down a hill. Start with something solid, let it gain momentum, and over time it will turn into something massive. That's exactly what happened with his Apple investment. Between 2016 and 2017, Berkshire Hathaway gradually increased its stake in Apple, accumulating over 61 million shares at an average price of around $110 per share. By the time February 14, 2017 rolled around, Apple's stock had climbed to $135 per share, marking a significant increase in value. And then came the earnings announcement, which sent the stock soaring even higher. With each passing hour that day, Berkshire Hathaway's Apple investment was increasing in value, adding billions to Buffett's net worth. But here's the real lesson. Buffett didn't buy Apple for a short-term profit. Unlike most investors who chase quick gains, Buffett was in it for the long run. His philosophy was simple. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. As Apple stock surged that day, Buffett's patience paid off in spectacular fashion. The world watched in awe as he made $12 billion in 24 hours. But what they didn't see was the years of careful planning and discipline that made it possible. Buffett wasn't celebrating or rushing to sell his Apple shares for a quick profit. Instead, he remained as calm as ever, sticking to his golden rule: hold on to great businesses for as long as possible. His belief in Apple's long-term value was stronger than ever, and as we would later see, his decision to keep holding would make Berkshire Hathaway even richer in the years to come. The world of investing is full of traders chasing short-term gains, but Warren Buffett operates on a different level. His $12 billion payday on February 14, 2017 wasn't an accident, it was a reward for sticking to his principles. Unlike most investors who panic when markets fluctuate, Buffett had a long-term vision for Apple. He wasn't investing based on rumors, quarterly earnings, or market speculation. He believed in Apple's brand, its ability to generate cash, and its deep-rooted customer loyalty. So, when Apple's stock soared after its blockbuster earnings report, Buffett didn't rush to sell. He knew there was still more room for growth. Buffett's investment philosophy revolves around buying great companies and holding them for as long as possible. His inspiration? The legendary investor Philip Fisher, who believed that the best returns come from holding onto extraordinary businesses through thick and thin. For Buffett, Apple wasn't just a company, it was a cash-generating machine. At the time, Apple had nearly $250 billion in cash reserves, something unheard of in the corporate world. It was also returning billions of dollars to shareholders through dividends and stock buybacks. This made Apple the perfect investment for Berkshire Hathaway. A wide economic moat, brand loyalty, and pricing power. Massive cash flows, steady income with minimal risk. A history of innovation, consistent product demand. Buffett was so convinced about Apple's long-term potential that he even admitted that he wished he had bought more shares earlier. The power of compounding, how Buffett's bet grew even bigger. Even though Buffett made $12 billion in 24 hours, the real magic of his Apple investment was just beginning. By the end of 2017, Apple's stock had climbed over 40% from its early year levels, adding even more wealth to Berkshire Hathaway. And the best part? Buffett never sold a single share. He understood something that many investors overlook: the power of compounding. By reinvesting Apple's dividends and allowing its stock price to appreciate over time, Buffett turned a great investment into one of the most profitable bets in stock market history. By 2023, Berkshire's Apple stake had grown to over $150 billion, a return of over 400% since his initial investment. What can investors learn from Buffett's $12 billion day? Buffett's extraordinary payday wasn't the result of a lucky gamble, it was the direct outcome of smart decision-making, patience, and an unshakable belief in quality businesses. Here are 3 key lessons from Buffett's historic gain. Ignore short-term noise. Buffett didn't care about short-term market fluctuations. Instead, he focused on a company's fundamentals, brand strength, customer loyalty, and financial stability. Think long-term. Buffett's Apple investment paid off because he was willing to wait years for it to compound in value. He didn't try to time the market, he simply bought a great business and held onto it. Trust the power of compounding. Buffett's investment philosophy is built around letting money grow over time. Instead of taking quick profits, he allows his investments to multiply, turning millions into billions. Buffett's $12 billion gain in one day may seem like an extraordinary event, but the truth is, it was just another example of his time-tested investment strategy at work. Warren Buffett has always said that his favorite holding period is forever. So, even after making $12 billion in a single day, he didn't rush to cash out his Apple shares. Many investors would have been tempted to sell at such an enormous gain, but Buffett understood something most people fail to grasp about the stock market. The stock market is a device for transferring money from the impatient to the patient. Buffett knew that Apple's success wasn't temporary. It was a company with a deep economic moat, strong financials, and a customer base that was almost religiously loyal to its products. Instead of selling and pocketing his billions, Buffett did something unexpected: he bought even more Apple stock. After witnessing Apple's strong earnings report and skyrocketing stock price, Buffett made one of the boldest decisions in Berkshire Hathaway's history. He increased his Apple stake, buying millions of additional shares. Between 2017 and 2018, Berkshire Hathaway's Apple holdings surged, making it the largest position in Buffett's portfolio. By 2020, Apple accounted for over 40% of Berkshire's entire stock portfolio, and Buffett's patience was rewarded again when Apple hit a $2 trillion market cap. His $30 billion investment in Apple had ballooned to over $150 billion, cementing Apple as one of the most profitable bets in stock market history. Why Buffett didn't fear market corrections? Even after Apple's stock soared, Buffett knew that market corrections were inevitable. Stock prices fluctuate. Bear markets happen. Corrections are normal. But Buffett wasn't concerned. He understood a key principle of investing. Over the long run, great businesses continue to grow despite short-term downturns. So, instead of panicking or selling during dips, Buffett stayed the course. This is what separates Buffett from most investors. He doesn't react emotionally to market swings. He doesn't chase quick profits. He doesn't fear volatility. For Buffett, investing is about owning pieces of great businesses, not trading stocks like lottery tickets. And Apple, in his eyes, was one of the greatest businesses ever created. The unbreakable Buffett philosophy. Buffett's $12 billion payday on February 14, 2017 was a remarkable event, but it wasn't a one-time fluke. It was a result of decades of disciplined investing. His approach to Apple was the same as his approach to Coca-Cola, American Express, and other legendary investments: buy quality businesses, hold them for the long term, and let compounding do the heavy lifting. His message to investors is simple. Find high-quality companies. Hold them for decades. Ignore market noise. Let your wealth compound. Warren Buffett's $12 billion gain in just 24 hours wasn't just about an explosive rise in Apple's stock price. It was about the application of Buffett's investment principles over time and the reinforcement of the idea that patient investing and a deep understanding of businesses can lead to extraordinary wealth. While his one-day windfall may seem surreal, it's important to recognize that this was merely the culmination of decades of discipline, focus, and a commitment to his value investing strategy. As Buffett often says, he doesn't just buy stocks, he buys businesses. The power of long-term thinking in action. For many investors, the concept of holding an asset for the long term can be intimidating. The idea of watching the market fluctuate over the years without selling at the first sign of a drop is difficult to grasp. However, Buffett's massive gain with Apple proves just how powerful long-term thinking can be. In fact, Buffett's $12 billion day was just one of the more recent illustrations of the results of his decades-long investing strategy. His belief in the power of compounding returns and the predictability of strong businesses has allowed Berkshire Hathaway to thrive for over half a century. What makes Buffett's approach even more remarkable is his ability to stay calm during turbulent times. In 2008, when the global economy was on the brink of collapse, Buffett made some of his most iconic investments. Yet, he didn't panic when other investors were fleeing the market in fear. He doubled down on his belief that, eventually, the market would recover and high-quality companies would return to growth. The investment lesson: avoiding the herd mentality. One of the key takeaways from Buffett's $12 billion gain is the importance of avoiding the herd mentality. Buffett doesn't follow trends or invest based on popular sentiment. Instead, he focuses on intrinsic value, the true worth of a company based on its fundamentals. For example, when Apple's stock was falling in 2013 due to concerns about stagnating growth, many investors sold off their shares, fearing the worst. But Buffett saw something different. He believed in Apple's brand power and its ability to continue innovating. Rather than listening to the noise of analysts and market pundits, Buffett ignored the short-term market sentiment and chose to view Apple from a long-term perspective. As history would prove, this move paid off in a big way. Buffett's influence on modern investing. Warren Buffett's approach to investing has left an indelible mark on the financial world. While many people still seek quick wins and instant gratification, Buffett has shown that the real wealth comes from understanding businesses, staying patient, and letting time do its work. Buffett's decision to invest in Apple also represents a shift in his thinking. While he avoided tech stocks for much of his career, he eventually recognized that the best companies transcend their industries. Apple wasn't just a tech company. It was a business with incredible brand loyalty and an unmatched customer base. This decision to embrace the tech sector, especially a company like Apple, has inspired other investors to rethink their biases and consider how much long-term value exists in certain technology companies. The $12 billion lesson for you. So, what can the everyday investor take away from Buffett's $12 billion day? The lesson is clear. Focus on the fundamentals, avoid the temptation of quick profits, and embrace the power of long-term investing. The stock market isn't a place for gamblers. It's a place for investors who understand the underlying value of businesses and have the patience to let those businesses grow over time. Buffett's $12 billion day may seem like an incredible fluke, but the reality is that it was the result of years of wise decision-making. For him, it wasn't about one big score. It was about making the right decisions day in and day out and then having the patience to see them through. In the end, Warren Buffett's true wealth wasn't built in a day. It was built over decades of consistent, thoughtful investing. And that's something every investor can learn from.